It's hard to imagine a G7 hyperinflating. Could it happen? Absolutely. It's mathematical. How does it end? Badly. That's how it ends. Badly.
I wanted to talk about like money printing because you saw that clip from Jared Bernstein. I think it's from the Stephanie Kelton's film. He's the chair of the Council of Economic Advisors, literally directly advising President Biden.
The U.S. government can't go bankrupt because we can print our own money.
It obviously begs the question, why exactly are we borrowing in a currency that we print ourselves? I'm waiting for someone to stand up and say, why do we borrow our own currency in the first place?
Like you said, they print the dollar. So why does the government even borrow?
Well, again, some of this stuff gets, some of the language that some of the language and concepts are just confusing. I mean, the government definitely prints money, and it definitely lends that money, which is why the government definitely prints money, and then it lends that money by selling bonds. Is that what they do? They sell bonds. Yeah, they sell bonds, right? Because they sell bonds and people buy the bonds and lend them the money. Yeah. So a lot of times, at least to my ear with MMT, the language and the concepts can be kind of unnecessarily confusing, but there is no question that the government prints money and then it uses that money to I guess I can't really talk. I don't get it. I don't know what they're talking about. Like, because it's like the government clearly prints money. It does it all the time, and it clearly borrows. Otherwise, we wouldn't be having this debt and deficit conversation. So I don't think there's anything confusing there.
It was concerning. Like, he basically fumbles over his words, ties himself into a pretzel, just trying to explain how the government like borrows money, prints money. I mean, he basically confused himself, it seemed like, in the clip. And I saw that in the Informationist, you wrote a thread and maybe an issue of that, kind of explaining what money printing is. And so, first off, what's your response from that clip? I have to ask you, and then maybe we could get into the specifics of money printing a little bit.
So, well, two things. I have heard that, and somebody put in the comments somewhere that it was from a few years back, and he was recovering from a stroke, and so that might be why he was fumbling over his words. And I don't know. I mean, I have not done the research. The thing is, well, if he's still in that position, he's answering these questions. Like, maybe he should have taken time off. But I don't know, so I can't comment on that.
That's fair. That's important to note.
I can comment on this is confusing stuff. I mean, this is really confusing. And you ask your average person on Wall Street, they have a general idea of how fractional banking works, how banks have reserves and they lend out money that kind of creates money. But the money printing that we're talking about printing money with QE, basically, in times of distress. And when you see a real fast expansion of the money supply. And what's really important about that is that that's what adds to inflation. We've seen it. We've seen that how it exacerbates inflation. That's what we're talking about here. And what's, it is, I did write a whole thread about it, so I won't go through the whole thread here and waste everybody's time. You can read it. It's on my Twitter today. But the punchline is the Fed goes out and they commission banks as intermediaries to go and buy bonds in the market for them, both treasuries and mortgage-backed securities. And they'll go and do that. And then the Fed just kind of presses a button and enters reserves on their balance sheet to pay for them. So then they can pass that through. And it's just money entering the system that wasn't there prior. And so it expands the money supply. You can see the expansion of the balance sheet of the Fed and the expansion of the money supply kind of go lockstep. And then there's further on, and we didn't talk about inflation in this thread. It was just about the money printing, but you can see a delayed effect where inflation starts to hit after the expansion of the money supply. So that's what's so important to understand about it. And so they basically can just print money. And they've said this before. They've said it on 60 Minutes. They've said we print money. That's what we do. So we'll never default. Why won't we default? Because we print money. No sovereign that issues debt in its own currency would ever default. Why? Because they can just print money and buy their own bonds. Look at what Japan is doing. They're doing the exact same thing. They've been doing it for years. And so they're running into issues with it, but that is exactly what's happening. And so that's what we have to, that's what we have ahead of us. So I think we have continued perpetual structural high inflation. And the reason we have that is because we must have liquidity in the treasury markets. And that means that we must maintain liquidity across the economy and across the markets in order to maintain that liquidity in the treasury markets, because we're not going to cut expenses. We're already spending more than we are legally bound to with mandatory expenses and with long-term contracts with the defense contractors, and then just the interest on our debt. Interest on our debt is $1.1 trillion right now.
Stupid.
It's ridiculous. Of course, they get some of that back because of internal holdings, but it's over $800 billion that we're spending each year on interest on the debt. And at the same time, we're spending roughly $4.1 trillion on mandatory expenses, Social Security, Medicare, Medicaid, unemployment. So just add those up, that's $5 trillion. When Sam, we took in $4.4 trillion of tax revenues, or that's what we're expected to take in this year. I mean, you don't have to be a math genius to see that that's not sustainable. Like, we have to do something. And so that's kind of where we're at. And that's why the money is printed to continue, because when we have these times of shock, we cannot have the treasury market act dysfunctional. Like, it has to keep functioning with high liquidity. And that's why they enter the market and they buy the bonds in order to splash liquidity into the market to make sure that the engine just keeps running.
Around Japan, and like, let's say they can kind of figure out a way to fix the supply and demand dynamics, it still seems like there's like a huge problem over there, and that the currency is just in decline. You said that the currency is the relief valve there.
Mm-hmm.
And I don't know if you saw this clip from Ray Dalio, but he kind of shared the major indicators before a coming currency collapse. And he was just talking more broadly, not about Japan specifically.
Time and again, the clearest indicators of when a fiat currency is going to decline into a collapse is when those who are holding its debt sell the debt, and the government, central bank, has to print money to buy that debt in large size while that's going down. Those are the most important indicators. So that you can see it, again, I want to repeat, selling the debt so that there's a big supply-demand imbalance, and the central bank having to come in there and buy the debt that no one else will buy in large quantity, so that then there's a currency devaluation. You have those three things aligned, the currency devaluation going down at the same time as those other two things are happening. And that's been a classic. It's like a bank run. They come to the bank, there's not enough money in the bank, and so they have to make up the difference by the printing of money.
But he mentioned that you need a massive amount of debt. So with Japan, that's check. The central bank buying that debt, check. And then a currency in decline, check, all at the same time. And that's a prerequisite, that cocktail for a coming currency collapse.
Yeah.
And obviously, like, people have been talking about this forever with Japan. But like, so where does this end? Like, it's hard for me to understand, like, how the currency, like, who's going to buy Japanese debt? What even is the right interest rate for when the debt is that high? I mean, it's like insane to me. Like, if they just let the free market do its thing, it would just completely blow up.
Yeah. Well, don't forget, Sam, that back in I want to say it was it was in the fall of 2020. We still had somewhere between 15 and 17 trillion dollars of negative yielding debt in Europe.
Yeah.
Negative yielding debt. That means if you bought a bond for 100 cents on the dollar, you got 97 or 98 cents back. I mean, it's just insanity. And so, but why did they do that? Well, because pension funds out there had no choice; they had to buy them. Like they were just, it's in their rules, and it's in their mandates that they have to buy these things. It's the same thing out in Japan. You have buyers of it. The biggest buyer is the Bank of Japan, and this can continue for a long time. But what we have seen in periods in declining, and you typically see it in Latin American countries, where you'll see an onset of hyperinflation. It's hard to imagine a G7 hyperinflating. Could it happen? Absolutely. It's mathematical. It could happen. One thing they could do though is they can continue to use deficits to create productivity on their mainland. And the way they could do that is becoming energy independent. One way to do that is to continue creating nuclear power with those deficits. That would help, but they have to import their energy for the most part now. And so, but that would help perpetuate it. Is it going to solve it? Not right now, unless they have some sort of productivity miracle. I don't see it. But I'm concerned about Japan. We've been talking about it now for almost 2 years and watching it get worse and worse incrementally. Again, they're playing chicken with the Fed. I think if we do have what we're talking about here, Sam, it's kind of two paths. If we have what we're talking about here, where we get into a period of higher inflation, and Luke Gromen talks about this, where you're just going to have a period of higher inflation. There's just no way around it. You have to have negative real rates. You must have inflation that's higher than the rate of return you're getting on your bonds. And if we do, as we enter periods of higher inflation, but if that drags those rates up, and it continues to put pressure on Japanese bonds and yen, well, that's not a good thing for them. That if we do that for the next 10 years, it would be extremely problematic for Japan. I believe that could be catastrophic for them. If we somehow get some sort of productivity miracle here, whether through AI or whatever else could happen, and we kind of skate through this without having to have massive inflation and really high interest rates, then that would alleviate some pressure out there. So it's really difficult to say how long this can go on for, but I believe it will continue to go on for a while. How long? I don't know. But how does it end? Badly. That's how it ends, badly. And sad to say, I mean, I have friends out in Japan, and I'm it's frustrating to see how massively these central banks have manipulated the system, and it's not working.
Yeah, I was just thinking about how crazy it was that you said Abenomics, that guy was assassinated a couple of years ago. I totally forgot about that. But he's kind of the one who kind of led Japan down this road, and obviously, and it's just insane to me that he was assassinated, because you don't really see prime ministers or central bankers assassinated like that.
Mm-hmm.